Good morning, Izzo. Good morning, Pav.
Hi, good morning.
Morning, James. Thanks for having us.
Well, thanks very much for doing this. We've had trade bridge opportunities on before, but with the other managers. So keen to hear from you. We've got quite a lot of slides. I think, as per usual, although we've talked to you before, let's sort of run through the case for the fund first, if you don't mind, and then we can bring in some questions from the audience.
Yep. Okay, that's fine. So I'm happy to start with that on slide 3, if we move towards there. So if we just think about what does this trust do? So for those that are hearing about us for the first time, we invest in both public and private equities within the UK, and our focus is small and mid-cap equities, so with market capitalizations of between £50 million and £2 billion. Our focus is on growth equity. So we want to find businesses that can compound their earnings over time and create value for our shareholders. And as you saw just the slide before, that we do have a strong team of individuals. So there's myself on the public equity side, Pav on the private equity side, and we are backed by a greater number of people in both respective teams, and then our other co-portfolio managers who unfortunately are not here today, Rory Batesman and Tim Creed. So if I move to slide 4. Thank you. So why public-private? So look, the first thing is that we think that what sets this strategy apart from other funds is that we have really an expansive universe that is not just focused on only investing in public companies or only investing in private companies. And because that universe is enhanced, it means that we have the visibility as to what the overall competitive landscape looks like for the companies that we invest in. So if you think about companies that list on the stock markets, they have their information freely available to everybody. So historically, there's always been greater insights that private equity investors can gain when making their investment decisions in terms of, how similar peers are faring. But the same hasn't always been true for public market equity investors. So in this way, through our strategy, we have the opportunity to invest in the best companies within a given industry, regardless of whether that company is public or private. And we think that in doing so, that we can deliver the best financial outcomes for our clients. I think that the second point here is also quite important, is that in creating a product that has private equity within it, we are providing democratized access to exciting companies that historically retail investors have not been able to access. And I'm sure we'll come on to that later on this morning. And then finally, in relation to the opportunity within this vehicle, we think that our assets on both the public and the private equity side are priced at a substantial discount to fair value, which we will explain shortly. So if we just move on to if we move on to slide 6, actually. Thank you. Yeah. Okay, so this chart shows the performance of our NAV, that's the green line, mapped against the performance of our share price, so that's the blue line, since the trust's inception. So we launched this trust at the beginning of December 2020. So in early 2022, we were trading at a very small premium to our net asset value. And then, as we all recall, the Russia-Ukraine crisis really began soon thereafter. Inflation continued to rise globally thereafter, as well as here in the UK. And then you saw central banks begin to increase their interest rates. And as a result, there was a market shift away from growth working as a style and towards value investing. So the combination of all of this, so basically I'm talking about weaker macroeconomic sentiment, that's really led to that decoupling that you see between both lines, and we're currently sitting on around a 33% discount to NAV. So perhaps I'll hand over to Pav to explain a little bit further.
Super. James, if you could just go to slide 10 at this point, we just talk about where we sit today. How do we fare and where do we sit today in terms of the portfolio positioning and the industry composition? We're 65% invested in private, 35 public. We actually removed a limitation that we had at the outset, which had a 50-50 split guidance in the fall of last year, and that was largely for two reasons. A, the performance in the NAV growth in the private was sort of pushing that limit, and also we wanted to have more autonomy in where we find the best opportunities, to Uzo's point earlier. And then if we look at it from a sector split, we're very diversified. We're a very diversified portfolio with a slight tilt towards technology, which we're comfortable about having. And just to give you some sort of data points as to where we are in terms of size, start of this week, we were about 78 million NAV, a market cap of around 51 million, and just shy of 8 million in cash as at 31 March, which has broadly been the case. If we move on to the next slide, James, you'll see here our top 10 holdings. And I think the key point to take here is we've got 8 out of 10 of the assets from the private side, and you'll see 2 public there. And the principal point here is the top 10 investments constitute broadly 67% of your total investments. And really what we have here is a very highly diversified collection of assets and exposure. So software, payments, healthcare, business services, and digital parking are some of the sectors or themes rather that we play in the fund. Perhaps with that, I will take you to slide 13, and I'll just touch a bit on the private equity strategy and how we look like in terms of the PE sleeve. So what we've tried to do here is really kind of illustrate and contextualize the private equity landscape by company life cycle. And the areas in the dark blue are the focus areas for this fund from a private equity perspective. So we invest in growth capital, and we also invest in buyout. And where we invest in buyout, we focus on the small and mid market, and that's typically enterprise values of 50 to 2 billion, as Uzo said earlier. And that's something that we invest in within this fund, but also as a private equity practice as a whole. And I'm sure the audience are aware, but when we say growth capital, we're talking about investing in companies that are in that growth phase and are requiring capital to fund further expansion. And where we talk about buyout, this is acquiring established and profitable companies and really drive strategic and operational improvements with the ultimate aim of achieving an attractive exit point. The other 2 things I just want to quickly draw out here are the 2 purple boxes on either side of the blue with the arrows pointed down. And really the point we want to make here is what we've been doing as a practice for some time alongside our data science team is really tracking how fundraising has been evolving in the private equity and venture landscape. And what we noticed is that in the late stage venture and pre-IPO market, as well as the mega buyout market, we've seen that the fundraising over the last decade has significantly exceeded the trend, our forecasts of fundraising when you look back at history. And what that had meant is that the growth in capital raised in these markets versus measured against the number of assets to deploy into was disproportionately large. So this is a part of a market that we intentionally have stayed away from, and ultimately we felt that would lead to pricing risk, and lo and behold it has, and these are the parts of the market that we would where we have seen as a private equity practice the most substantiated retrenchment in valuations, late stage and late stage VC and mega cap buyout. The top and tail boxes, venture, seed, and turnaround, we invest in as a practice, but we don't invest in within this strategy. And then moving on to slide 14, what does our strategy look like on the private equity side? I think the key point to bring out on this slide is that we have built a private equity portfolio that is biased towards buyout companies, which in the main are profitable companies that exhibit high EBITDA margins and very high cash flow conversion rates. But the portfolio was intentionally constructed to have exposure to some exciting growth assets, and that's really, that gives us the ability to deliver the outsized returns and really augment our portfolio construction. In terms of the portfolio as a whole, I'd say 8 out of 9 companies are meeting or significantly exceeding our base case underwriting at the time of investment. And just talking to those in terms of the aggregated portfolio metrics, we've seen, on average 40% sales growth over the last 12 months and 45% EBITDA margins in the profitable names. And that's, that kind of talks to the strength and resilience of the book that we've built. Uzo, perhaps I'll pass back to you to just touch on the public equity strategy.
Yeah, thank you, Pav. So James, if we could move to slide 18, if that's all right. Yeah, perfect, thank you. So as we mentioned earlier, that we look at companies on both the public and the private side with a £50 million to £2 billion market cap. And within the public equity sleeve, we think about our opportunities in two broad buckets. So the first is what we call mispriced growth. And these are companies that may have had a little bit of a wobble in terms of their share price, but we think that the market is materially undervaluing the long-term opportunity, possibly because they need an fresh equity capital raise is required in order to restore their balance sheets. There was more of an opportunity to invest in some of these businesses during the pandemic, as balance sheets had become a little bit over-levered with companies that still had really strong global franchises. For example, a company called SSP, whose rights issue that we participated in 2021. Then we have another bucket in which we call high growth, and this really is our bread and butter. So it's important to stress that we don't really do that much mispriced growth, that the high growth opportunity is where we see most of our investments being. So we look for businesses that are compounding their revenues and earnings really, really strongly. So these companies have really strong balance sheets, but perhaps maybe they may need to come to the market to raise equity from their shareholders in order to fund, for instance, a transformational M&A deal. So whilst we don't just invest in opportunities that require equity funding, we do support we do think it's important to support our investee companies for transactions that we think would be earnings accretive. And in total, just for context, we've participated in around 13 primary or secondary equity raises and about 4 IPOs since the launch of the fund. So I'll just hand over to Pav.
If you could go to slide 22, please, James. This is for us, a key slide and a key message that we want to leave with our audience. This is our views on the mispricing and the discount that we're currently trading at. Internally, we call this the math slide. And just to take you through, what we have on the left-hand side is the NAV per share bucketed into the different components. So, broadly 33% of NAV in public, 7.9 in cash, and 61p worth of value from the private equity investments. And how does that marry up to the share price? Well, if we make the assumption that the equity markets are prudent are pricing in prudence on the UK side in terms of UK sentiment and also growth assets, and that is so your value is fully reflected there. You've basically got your 33 pence. Cash is cash, which is a 7.9. The plug figure becomes 27.5 pence. So that implicitly implies a 55% discount on that the market is pricing into the private equity investments, which we think is a huge injustice. On the basis of the powerful growth that we've had in the companies in terms of the underlying earnings. And by the way, most of that is driven by the fact that we have a lot of market leaders in their respective niches and have been able to grow in what are very tricky economic conditions. And B, we've priced in a significant multiple contraction into the valuation of our assets. And, as a practice, we are we always take a very prudent approach. And so, in spite of that, we are still being kind of tarnished with this significant discount. So, the point to make here is, I think, we believe this is a very attractive entry point for investors. Uzo, do you want to just wrap up on the outlook?
Yeah, sure. So next slide, please. So just to wrap up our presentation, so our private equity allocation has performed very, very well, and we are really excited about the progress there. And the public equity side of the portfolio, even though it has been held back by negative market sentiment within the small and mid-cap space, we do see significant discounts in several of our stocks. And it's worth pointing out that 3 of our companies on the public side were actually taken out, or rather they received bids last year, and 2 of the 3 were successfully taken out, either by corporates or private equity. And just from the opportunities that we see in the public sleeve, we do think that there's potential for more to come. And then finally, our enhanced universe, which I mentioned at the start, really means that there is no shortage of investment opportunities from our perspective. So yeah, thanks a lot, and I'm happy to answer questions.
That's great. Thank you both.